All right, so I hope everybody enjoyed that presentation and you took a lot of notes. And what we're going to do now is Jeff's been monitoring the chat room and he's emailed me a list of all the questions so I can see that he's got those. So Jeff, why don't you go ahead and just go from the top of your list that you have there, and we'll just take them in the order in which they came in, and we'll take them one at a time, and we'll stay on as long as we have time for. So go ahead and ask me question number one, and we'll get the Q&A session started here.
The first question is from Katrina. I am 66. Am I too old for this strategy to work for me?
Well, Katrina, we never want to say that anybody is too old ever, because we just really never know exactly what your situation is. However, if somebody is outside the ideal age range to do an index universal life insurance strategy, we do have other strategies that we can segue you into. For example, we do have a brand new annuity that just came out that is a no-fee annuity. There's absolutely no fee to it whatsoever. That's what used to give annuities a bad rap, was the fees associated with it. So this annuity actually has no fees. It's very similar in the lock and the reset feature of the index universal life insurance policy, and it also has a 20% deposit bonus on your initial deposits during the first year. So it's another strategy that can work exactly like the IUL, except for the fact that you do not have the tax-free retirement income, nor do you have the death benefit. However, it is a byproduct of things that we will work with if somebody is either too old for the ideal IUL strategy to work, or if they have health conditions that would otherwise preclude them from being approved. So the important thing is to always fill out your survey and to get us your information so we can analyze your situation and schedule that appointment with us.
Our next question is from Martin. Is this a variable product?
Well, Martin, I'm assuming that this question came from earlier in the presentation, but absolutely no, this is definitely not a variable product. In fact, in 2006, I believe it was, I drew a line in the sand and I told myself that Clear Diamond Life would never have anything to do with a product where our clients could possibly lose their money. So therefore, at Clear Diamond Life, we're never going to suggest or represent any products that are variable in nature, nor do we have any money under management. In fact, I don't even have a securities license for that exact reason. However, depending on the Department of Labor ruling that is currently being reviewed, we may be forced to hold a security license in order to assist our clients with qualified account rollovers to annuities. But again, that would be the only reason. So to reiterate, at Clear Diamond Life, we do not offer nor do we sell or represent any product that is a variable product where you could possibly lose any of your money. We leave all that up to the money managers or your financial planners. So we only want to focus on the portion of your portfolio that you cannot afford to lose.
Next, a question from Nate. Could I set this up for my grandkids?
Nate, absolutely. We assist many of our clients with this strategy actually under our legacy planning umbrella. And as it says in our mission statement, we don't just make a difference in people's lives today, but we have a resounding impact on tomorrow, the future, and for generations to come. So not only can you set this up for grandkids, you can also set it up for your children directly as well. So again, it really depends on your unique situation and what it is you're trying to do. So again, complete your survey, put that in the special comments section that you would like to focus on doing this for your grandkids or your children, and we'll pay special attention to that note. So when we chat with you, we can discuss exactly what it is you're trying to do. But bottom line, the answer is yes, absolutely. You can set this up for just about anybody, including charities, foundations, animal shelters, your college, your university. Really, any place you want to leave your money to, we can assist you in that arena very easily.
Our next question is from Amber. I have a 401k from a previous job. Am I able to transfer that into this plan?
Amber, I'm really glad you asked that question because this one comes up quite a bit at our live events, and there's a lot of moving pieces to the answer. But the bottom line is, if you're under age 59 and a half, you will not only have to pay taxes on that transfer, but you will also have a 10% penalty if you are under age 59 and a half for taking that money out early. So we want to pay very close attention to your exact unique situation, because sometimes it would make sense to do that, and then there's other times where it absolutely would not make sense to do it. So again, in your survey, when you fill that out, put that in your special comment section, that you do have a 401k rollover that you're considering cashing out from a previous employer, and we want to pay very, very close attention to that. Now, if you are over age 59 and a half, with Trump's proposed tax plan, there is a pretty significant window of opportunity where it will make sense for a lot of people to do that if you believe that tax rates in the future are going to be higher. Because if we pay those taxes now, get that money out of the markets where it's at risk, and put that money into a vehicle where it's completely safe and will participate in the markets without being at risk in the markets, there probably could not be a better time in our history if you remember what those charts look like when you look at the history of tax rates. Now, there is a national CPA by the name of Ed Slott that appears on PBS programming regularly, and he fully endorses the maximum funded index universal life insurance contracts for this exact reason, because his belief is that if you get your money out of these accounts now while the taxes are lower, it's going to be very favorable. In fact, he refers it to moving your money from accounts that are forever taxed to accounts that are never taxed. So again, age has a lot to do with it, and we want to really, really take a look at it to see if it makes sense for your particular situation.
Next question is from Penny. We live paycheck to paycheck. What can we do?
Well, Penny, again, remember, everybody's situation is unique, but it sounds to me like you may be in that bottom 75% of wage earners where you may want to act upon the advice from the other financial entertainers that I referred to earlier, such as Susie Orman and Dave Ramsey, because like I said earlier, they do offer great advice for assisting people with knocking down debt and establishing savings plans. And then once you're in a position where you have at least 6 months in reserves and you're able to contribute, let's just say at least $500 a month to retirement savings, then at that point we would be more than happy to assist you. But we never want to put the cart before the horse and make somebody's situation even worse for them. So if you don't have at least 6 months in reserves, and you truly are living paycheck to paycheck and you're not able to save any money, now would be the time to really focus on paying down credit card debt and managing your money that way first before we even look at these type of strategies. So again, I want to reiterate that everybody's situation is different and unique. So if that's what your question was pertaining to, that's what my advice would be. Now, if you do have money that you are currently contributing to a 401k plan and you're contributing more than your employer match contributions, just like in the Richard and Grace Turner video that we watched, we may be able to reposition some of your other funds if you do have those funds available to use that money more efficiently. So again, if that's the case, complete the survey, fill out that financial questionnaire, send it over to us, and again, we'd be more than happy to look at it for you.
The next question comes from Jackson. I've heard the phrase buy term and invest the difference. Why is this better?
Well, Jackson, I think we went pretty deep into that question during the presentation. But again, if it's basic insurance that you're looking for, this is definitely not the strategy for that purpose. Because remember, when you're making that minimum premium payment allowed in cash value life insurance, this is not a wise financial decision if your goal is for cash growth. Now, if your goal is to have insurance, we're more than happy to sell you a standalone policy for those purposes. So again, in this strategy, we are advocates for maximum funding in Index Universal Life Insurance contract, again, to enjoy the long-term tax benefits and the leverage that the strategy affords while we enjoy uninterrupted compounding of interest. And again, we can go much deeper into those benefits of the strategy, and we do so in our educational videos that you now have free lifetime access to once you complete and return your confidential wealth assessment. So at the very least, complete your information, send it over to us so we can give you access to that video library so you can dive deeper into these strategies if there's some part of the presentation that you didn't understand or some part of the strategy that you missed earlier. But again, buy term and invest the difference. Why is this better? This is better because we're not doing it for the maximum amount of insurance that we can buy with our money. Again, if you remember, what we're doing is we're throttling back that death benefit or that face value of these policies to the minimum allowable by Internal Revenue Service guidelines so we can have the least amount of costs for the maximum amount of cash growth. That's where the strategy will almost always outperform a 401k plan or any of the other investments that we can compare these things to side by side. So again, when you get your confidential wealth assessment after you submit your survey, you will see how we compare these different accounts side by side with each other, and then we will prove to you why and how this will outperform almost every other financial strategy that you have access to currently.
A question from James. What does maximum funded mean? How does max funded work?
Jane, here's a question I was really hoping someone would ask, and it kind of shows me that you were actually paying attention to the presentation. So, and it's also a continuation of the previous question that we just had. So basically, when we say maximum funded, that means we want to get as much cash into the policy as fast as is possible under the guidelines established by the Internal Revenue Service in order to keep the policy in a tax-favored status. So typically, it's going to take between 4 and 6 years to maximum fund a policy depending on your age. But as an example, let's say we were going to fund a policy with a total premium of $100,000. That's how much money you had to put into the policy. It's going to take us about 5 years to fund it. That means we can only deposit $20,000 into the policy for the next 5 years. So again, what we're trying to do with these policies is to get as much cash into the policies as fast as we can, and again, in accordance with those guidelines that we showed earlier in the presentation that are set by the IRS, which are Section 7702, Section 101, and Section 72E. And again, this strategy is very, very complex, and you want to work with somebody that is highly trained and highly skilled, like we are at Clear Diamond Life, in implementing these strategies properly. Because if you remember, all agents have access to these types of policies, but not all of them know how to structure them properly for the maximum cash growth and the least amount of costs. So once again, complete your survey, submit your information to us, and we'll be happy to analyze your unique situation. Jeff, what's the next question you have?
LaShawn asks, is this whole life?
LaShawn, this is probably another question that came on early in the presentation. So again, when we covered the permanent types of insurance, we had whole life, we had variable life, and then we had indexed universal life. And this is really what the strategy focuses on, is using exclusively indexed universal life, opposed to whole life, where remember you have that minimum premium payment you make for your whole entire life, and the costs associated with the policies are much higher because they're not structured the way that we're structuring the index universal life insurance strategy by maximum funding it. So again, no, it's not whole life. This is exclusively indexed universal life.
Our next question comes from Akio. I have an existing whole life policy. Is there anything that can be done with it if I want to transfer it?
Jeff, I didn't catch that name, but I think you said Akio, and if I'm mispronouncing it, I really apologize. But Akio, if you have an existing whole life policy that's been in effect for quite some time, and you don't think that it's structured properly, or you think that that money's not being used absolutely efficiently, that's another situation that we can absolutely take a look at for you, and we can do what's called a policy review and make sure that that policy is structured efficiently for you. And if it's not, you can do what's called a 1035 exchange directly into the Index Universal Life Insurance policy that you're starting and establishing. So that money is transferred, 100% of that cash value goes directly into the policy immediately, and it doesn't have any limitations on the funding of the rest of our policy as far as how fast we can put money into it. So that's you kind of get an exemption from the amount of cash value that you currently have built up into an existing whole life policy. Or also sometimes we even find some of those old universal life insurance policies, like we referred to in the presentation, that E.F. Hutton created for his clients back in the day when you didn't have the IRS limitations. And sometimes those even present opportunities for us. So again, if you have existing policies, those are definitely something we want to review when you fill out that personal information on that survey, and list those policies, because we want to look at each and every life insurance policy you have currently, whether it's cash value life insurance or just regular term insurance. And I hope that answered your question.
Our next question is from Michael. I don't have a family. Why would I need a death benefit since I have no one to leave my money to?
Well, Michael, obviously you're focusing on the death benefit or the wealth transfer phase of this strategy. And the simple answer is that while you may not have a family member to leave your estate to, many of our clients will list their favorite charities, universities, animal shelters, city parks, or really any organization that you can think of that could benefit from the wealth transfer of your life insurance policy. So, it is a wonderful way to create that legacy for yourself. But again, that real reason that we're using this strategy is for the market gains and the living benefits the strategy has to offer. And that's really the main reason. And kind of like we said earlier, the life insurance component of this strategy is nothing but the cherry on top of that banana split. So the legacy part of the strategy is one of the main aspects that we're very committed to at Clear Diamond Life, and that ability to make such a profound difference to future generations. But again, the living benefits is really where the strength and the power of the strategy comes from. And I think you'll see exactly what I'm talking about once you receive your personalized wealth report, where we list all the accounts side by side and we compare apples to apples with the Index Universal Life Insurance strategy compared to your 401ks, compared to your Roths, compared to your other tax-deferred accounts and your other tax-free accounts. And it's at that point that a lot of people have their first epiphany when they actually see that their money in this strategy will last into perpetuity compared to the other accounts where their money actually will run out, typically starting at age 72 to 75, and they're completely out of money in the 401k, or they're completely out of money in their tax-exempt accounts in their early 80s, where not only does this money continue into perpetuity, but then again we have that death benefit that does transfer, if not to your family, to whatever charitable cause or foundation that you want to create. So it is an extremely powerful strategy from that standpoint.
Our next question comes from Cameron. It's really more of a statement than a question, but we'll still address it. It says, I heard the commissions were really high and the fees are also high.
Well, Cameron, you are absolutely correct in the fact that these policies can have high fees and they can have high commissions. In fact, that's where that phrase that we referred to earlier, buy term and invest the difference, originally came from, because agents that are not properly trained in this strategy have really given it a bad name because of that fact. So again, what we do differently at Clear Diamond Life is we reduce that death benefit to the minimum allowable by Internal Revenue Service guidelines to take advantage of the living benefits the policy has to offer. Again, that is liquidity, safety, favorable rate of return, tax-free retirement income, and tax-free wealth transfer. So again, by reducing that death benefit or that face amount to the minimum allowable by Internal Revenue Service guidelines, we are going to keep those policy costs and fees about 30% less than somebody else that would structure this policy without the knowledge that we have at Clear Diamond Life.
Okay, our next question comes from Lloyd. Is there a limit to how much money I can put in?
Well, Lloyd, we rarely run into a situation where we have someone that wants to put more money into it than they would otherwise qualify for. But to answer the question, yes and no as far as are there limits. So here's how it works. Everybody has what they call maximum insurability. So you have to qualify for the amount of insurance you're applying for. And what I mean by that is, let's say that you're a single male and you want to apply for a face amount of $5 million, for example. Unless you have significant assets, you're probably not going to meet the underwriting guidelines that would justify the need for that much insurance. However, almost anybody will qualify for at least $1 million worth of face amount. And remember, what we do differently at Clear Diamond Life is we reduce that face amount down to the minimum amount allowable by Internal Revenue Service guidelines. So let's just say that you thought that you were going to need a $5 million policy. Well, you may in fact only need a $2.5 million policy by the time that we reverse engineer all the numbers to get that death benefit down to the minimum amount allowable to reduce the cost and the fees associated with the policy. So again, yes, there are limitations, but rarely do we come into a situation where somebody wants to put more money into a policy than what they would otherwise qualify for.
The next question comes from Chin. What if I have health issues?
Well, Chin, that's another great question because it's a multifaceted answer. So if somebody has health issues that they perceive that they have, actually the underwriters may have a different opinion than you do. For example, we actually had a client recently that had had a heart attack more than 2 years ago, and they didn't think that they would be approved, and they were actually approved for for a favorable rating. So you just never know what somebody's situation is. So we always want to make sure that we take a full look at exactly what your situation is, what your health issues are, and if you do have health issues that preclude you from participating in this strategy, remember we do have other financial vehicles that are almost just as good as the Index Universal Life Insurance strategy in the form of the no-fee annuity that I referred to earlier. Annuities get a bad rap a lot of times because of the fees associated with them. Well, this particular annuity that we have has got no fees whatsoever. It has a 20% deposit bonus, and it is a fixed indexed annuity where you would never lose your money. And it operates almost exactly the same as the Index Universal Life Insurance strategy with that lock and reset feature. The only downside is you're not going to have that tax-free retirement income, even though you do have a death benefit transfer within that annuity. Now, there is another product we have called a structured cash flow for somebody that would not otherwise qualify for the IUL strategy, or they may not want their money to be locked up for 10 years with the annuity strategy. So there is a way that we can help almost everybody regardless of your situation. So again, complete your form, send that survey in, and let's get your personal wealth report created for you so we can look at everything side by side.
Our next question is from Hayo. How is this tax-free income?
Well, Kyle, if you remember in the presentation, this is one of the main reasons we do this strategy is for that tax-free retirement income. And again, those guidelines are clearly defined by the Internal Revenue Service under those 3 sections of the tax code that we referred to within the presentation. Again, we go deeper into this strategy in our video series that you have access to by completing your survey and sending us your information. So again, send us your information, complete that survey so you have access to the videos where you can go back and get more in-depth information, and you also get a replay link to the webinar that we're going through right now. And that way you can go back and cover that section again.
Jacob submitted the next question. I like the concept, but where can I find more information?
Jacob, if you go to our website, which is www.cleardiamondlife.com, and click on that resources tab, you'll find a list of all of our other third-party articles, books, and other information we'd like to have our clients review. Also, our video library is very extensive. We go very, very deep with additional information on these strategies. So again, if you've completed your survey and your wealth assessment and sent it to us, you now have access to that video library. There's 13 of them, I believe, and they're about 12 minutes long each. And we go very, very, very deep into this strategy because we want to make sure that you're fully educated before you decide whether or not this is right for you. So again, www.cleardiamondlife.com and click on that resources tab. One of my favorite books that I like to refer my clients to is a book by Patrick Kelly, and it's called The Retirement Miracle. I highly recommend my clients read that book as well because it is an independent third-party review of this strategy. Another independent third-party source is that CPA I referred to earlier. His name is Ed Slott, so it's ED SLOTT, and Ed appears regularly on PBS programming. He's not only an ambassador for the strategy, but he advocates it to his clients as well. Jeff, what do you have next?
Our next question comes from Padmakar. Is there a charge to meet with you?
Jeff, I'm sorry I didn't catch the name for that question, but the answer to it is there's absolutely no charge whatsoever to meet with us ever because we get paid directly by the insurance company only if we implement a plan for you. And remember what I said earlier is we're going to reduce that death benefit to the minimum amount allowable by Internal Revenue Service guidelines, so that also reduces our commissions compared to somebody else that may do this strategy for you or attempt to do this strategy for you and not structure your policy properly. Because remember, at Clear Diamond Life, we're going to do everything possible to minimize the fees of these policies because we want to make sure that our cash growth is the maximum it can ever be. So again, there's absolutely no charge to meet with us ever. And the other thing is, you will never send money to us for any reason. So whether you're implementing the Index Universal Life Insurance strategy, or you're purchasing an annuity, or you're doing a structured cash flow, your money will never transfer to anybody at Clear Diamond Life. It goes directly to the insurance carriers. So again, absolutely no fee to meet with us whatsoever. Great question.
Our next question is from Olaf. I am in Minnesota. Do you have offices here?
Well, Olaf, even though we don't have an office in Minneapolis at this point, Jeff has actually just moved back to that area, and our plan is to open an office in Minneapolis later on this year. However, typically we meet with most of our clients online or through web-based meetings, but that doesn't mean we don't want to meet with you in person. So we do have clients that will fly to our main offices in San Diego. We also have an affiliation with the Live Abundant group out of Salt Lake City as we run the Live Abundant radio show in the Las Vegas market. We also have an affiliation with one of our offices in Columbus, Ohio. So if we ever do need to meet with you in person, flying to one of these locations is a definite possibility.
Our next question comes from Wendell. What insurance company do you work for?
Wendell, at Clear Diamond Life, we are an independent firm and we represent over 50 of the top insurance carriers in the nation. However, unlike a captive agent, we are able to shop for the best products for your particular situation. So we're not just limited to, say, MetLife, Farmers, or State Farm as an example. And for this particular strategy, the majority of our business is actually placed with 3 of the top rated insurance carriers in the country. So it really depends on exactly what it is we're trying to do for you. But just know that we're able to shop for the best product for you, and we're not limited to having a specific set of products that another agent may be bound to.
Next up, from Elizabeth. How can the insurance company do this?
Well, Elizabeth, this question is simple on one hand, but complex on the other hand. Now, we do cover this in depth in video number 11 in the video library that you have access to once you complete your survey. But just real quickly, for every $100 of premium that you pay, $95 of that goes into the insurance company's general portfolio, and that portfolio is very well balanced and conservative in nature. So the insurance companies know that this fund will yield a return that will get them back to their original $100 investment. So the other $5 that they have, that goes into options where those returns can be 10, 12, 13, 14% or beyond. And since we don't have a lot of time to go into it, again, you can find more information on this in video number 11, or we can discuss it in much greater detail during your appointment.
Our next question is from Beatrice. This really sounds too good to be true. What's the catch?
Well, Beatrice, there really isn't a catch. Cash value life insurance products have been robust financial vehicles for decades, and they should absolutely be a portion of your well-rounded portfolio. But I guess if I were to think of a catch, maybe it would be that it ultimately is insurance and you need to be able to qualify for the coverage that you're applying for. So just because you have the money doesn't necessarily mean you automatically get to participate in the strategy. However, at Clear Diamond Life, rarely do we encounter a situation where we're not able to help somebody in some way, but this is a very carefully designed strategy, and when combined with other financial vehicles that you have, it does create a very balanced and well-rounded portfolio, and it's one that should be part of everybody's financial strategy.
Our next question comes from Javon and is really quite interesting. My son is a soon-to-be professional athlete and has a substantial signing bonus coming his way. This sounds like a perfect place for his money so that it can grow and be available for him at retirement. Am I right in my thinking? I don't want him to end up like Dennis Rodman or the like.
Wow, Jovan, that is a pretty intense question. So just to let you know, among our clients are many entertainers and professional athletes that have taken advantage of this strategy. These type of candidates are ideal for maximum funding a policy as they typically have the immediate resources to fully fund their policies and as fast as possible in accordance with the IRS guidelines that we want to maintain for the living benefits and the tax-free retirement income. But this is where the power of that compound interest and leverage really supercharge these policies, because the growth potential is so great, and this is how these individuals that maximum fund these policies provide for their future. They form foundations, they donate to charities, provide for their families for many generations to come. So when we think about the amount of money they have to put into these policies, sometimes we see policies that are $10, $15, $20 million deposits over the course of 4 to 5 years. Let's just say that we had $10 million that we were going to put into this policy over the next 5 years. So basically we would be putting $2 million per year for the next 5 years into the policy. Well, using the rule of 72, we know that if we're going to average say 7.2% return on our money, it's going to take us 10 years to double our money. So I'm assuming that your son is probably 21 to 22, somewhere in that age range. By the time he reaches age 25 to age 26, he's going to have all of his money deposited into his policy to where he never has to make another premium payment. Now, when he's ready for retirement at age 65, we know if he's averaged 7.2% rate of return, that money has now doubled itself 4 times. So that $10 million is now worth $160 million. So imagine being able to access $160 million tax-free. How long could you live on that money? Now, I know that's an extreme number and it's an extreme example, and that's exactly what the wealthy have been doing for decades. Now, again, our target audience is anyone that makes over $168,000 per year in combined family income, because they are typically in that top 25%. So can we help your son with this strategy? And is it a good idea for him to do that? Yes, absolutely, because now what he can do is he can guarantee that he will never outlive his money, and he won't end up like people like Dennis Rodman. So I'm trying to remember this right off the top of my head, but according to Sports Illustrated, I think they said that 78% of all NFL, and I believe it was 60% of NBA players, go bankrupt or they're under financial stress within 2 to 5 years after their retirement from their respective sport. So by implementing a properly structured, maximum funded, tax-advantaged, Index Universal Life Insurance contract, it can definitely protect them not just into the future, but for generations to come.
Our next question comes from Lorraine. Are there penalties for early withdrawals?
Lorraine, no, there's absolutely no penalty for early withdrawals when we're talking about the Index Universal Life Insurance strategy. Again, that's one of the main benefits of this strategy, is that you can access your money at any time in the form of policy loans without penalty. Again, I just want to reiterate that this is a very advanced strategy, and we want to discuss it with you in great detail. The other advantage to having penalty-free access to your money is that there's not a set payback schedule. However, remember, if you withdraw the money early and you don't pay it back at some point in the future, the policy may not perform as we originally illustrated. That's why we have our annual review, and we want to review with you everything that is going on in your life at least once a year, so we make sure that we stay on track with every moving aspect of the strategy. Again, that's why you want to work with somebody that's highly trained and experienced in implementing the strategy for you.
The next question is from Kathy. Would having a policy like this count against me to qualify for college financial aid?
Kathy, this is a great question because it brings up something else I wanted to cover. But essentially the answer to your question is no. Cash value life insurance is actually exempt from FAFSA disclosure requirements in most cases. And this is what Jeff specializes in, is using this strategy specifically for college planning purposes, as it is a much better option, in our opinion, at least for the top 25%, compared to the 529 plans. There's many moving parts to using this strategy for college planning, but properly structured, it does have incredible possibilities. In fact, many of our clients that didn't think that they could actually qualify for college aid have actually received thousands of dollars in financial aid that they otherwise would have had to take from their own pockets by transferring money from various accounts. So again, if there's someone in your family that is getting ready for college, let us know in the special comments and we'll be sure to enlighten you on that topic. The other thing to circle back to is for the grandparents that had that question earlier, these are perfect strategies to implement for grandchildren, because by the time the grandchild has reached college age, which is typically around age 18, that money may have already doubled itself twice, and now we can use that in the form of policy loans to fund the college education, where that money has no set payback schedule and it can be paid back at any time in the future, while that original deposit in the account continues to grow using compound interest. So it is an incredible strategy for college planning.
The next question is from Jigs. Is this something my financial planner can do for me?
Well, Jigs, that's what I keep emphasizing over and over and over, is even though most agents and financial planners may have access to the carriers that we use to implement these strategies, they are definitely not experienced in implementing them properly to minimize the costs associated with the policy. So it's possible that they could do it for you, but it's highly and extremely doubtful. This financial strategy is our main focus at Clear Diamond Life. And again, we're highly trained and highly skilled in ensuring these policies are structured properly for tax compliance purposes, as well as minimizing the overall policy cost by ensuring that the amount of insurance being purchased is the smallest amount that is required according to the Internal Revenue Service requirements. And once again, I want to reiterate that as we stated during the presentation, we're not looking to replace your financial advisor or your insurance agent by any means, but this strategy should be in addition to your overall balanced portfolio, and we only want to help you with the portion of the portfolio that you cannot risk to lose. So we have found that when you do use your advisor or your own insurance agent to implement this strategy, that the commissions and the fees are much higher, not allowing the policy to perform as illustrated. So again, this is all we do at Clear Diamond Life. It's our sole focus. So I guess the question back to you would be, if you needed heart surgery, would you want to use a doctor that was a cardiovascular surgeon, or would it be okay for your family doctor to perform the procedure? So I hope you get the picture. Your financial advisor has a lot to keep up with when it comes to managing your money, and learning and implementing the strategy takes years and years of training, just like the surgeon. And this is where we are experts at Clear Diamond Life. So I hope that answered your question.
Our next question comes from Dexter. I don't have a lot of money to start a plan like this, but I know I have money coming to me. Are there any other options?
Well, Dexter, we never want to put the cart before the horse, but if you remember from Richard and Grace's video, we were able to find additional money that they were using inefficiently to help them fund their policy. Now, there are other circumstances where people think that they have money coming in the future in the form of signing bonuses like we heard from Javon earlier, or they may have a family inheritance coming their way, or they may have a bonus coming, but we never want to plan on that money when we're implementing a plan or looking at the strategy until we know that we actually have the money in our hands, because too many times in the past we have seen people that thought that they had money coming and it never arrived, and if they would have had a policy structured in anticipation of that money, it would have led to nothing but disappointment for everybody involved. So no, we never want to work at perceived money that may be coming in the future. We only want to work with money that we have in our hand, or that money we can find that may be being used inefficiently. So Jeff, I know I've gone more than 30 minutes so far, but these are all pretty good questions. So let's take a few more questions and we'll just go ahead and keep this going, and we'll probably wrap it up at a full hour just for the Q&A session, because I really think it is valuable content. And since there are so many questions, I just want to try to hit as many as we can. And for those of you that are listening at home, remember, we are going to send you a replay link so you can go back and listen to this at your convenience. So you can slow it down and take notes and pause it wherever you need to, because before we schedule your appointment, we want to make sure that you're as educated as you possibly can be, so it saves time for us and it saves time for you as well, and we can use our time much more efficiently that way. So Jeff, let's go ahead and give me a few more questions here, and then we'll wrap it up right at the hour break.
Our next question comes from Deanie, and it's really more of a statement, but we'll address it anyways. She said, "This sounds like some sort of a tax loophole."
Well, Deanie, this is actually anything but a tax loophole, and I know we already covered this, but again, maximum funded, tax advantage universal life insurance contracts have been used by the wealthiest individuals, both for business personally and to protect and grow wealth for decades. So this strategy is fully defined under the IRS sections 7702, 72E, and 101A of the tax code, similar to how they've defined rules under section 401K of the tax code for the plans most people are familiar with. So it's definitely not a loophole. It's just that we have learned how to maximize the advantages under these IRS guidelines to make the strategy outperform most 401ks and other retirement types of plans for the purposes of liquidity, safety, favorable rate of return, tax-free retirement income, and tax-free wealth transfers. So no, it's definitely not a tax loophole.
We have another statement question coming as well. This one's from Fam. "It looks like you're simply trying to sell life insurance."
Well, fam, again, not at all. In fact, if life insurance is what you want, this is definitely not the program for you, and we covered this in the presentation. But again, using this strategy, the life insurance component just happens to be the vehicle that allows us to take advantage of the benefits this strategy has to offer. So again, we look at the life insurance component or requirement portion of this strategy as that cherry on top of that banana split. It is what protects you ultimately in the end from any risk of loss, while you put yourself in a position to enjoy the leverage, the uninterrupted compounding of interest, and the tax-free living benefits this strategy has to offer. Again, I want to reiterate that at Clear Diamond Life, what makes us different from everybody else is we know how to throttle back that death benefit to the minimum amount allowable by the Internal Revenue Service to stay in compliance with those very complex tax codes we have been referring to throughout this presentation.
Our next question is from Lucia. Why haven't I heard about this before?
Well, Lucia, this is actually kind of funny, but the first time I heard about this strategy, and I was being trained on the strategy back in 2006, I asked that same question, and the response I get was I was told that I needed to get out more. But actually, the advantages of maximum funded tax advantage life insurance is really no secret. The strategy is very complex for the average financial planner or financial advisor to implement properly without having years of training or experience. And sadly, many financials and tax professionals that have not done their research on the intricacies of what we teach, they end up demonstrating resistance to the strategy due to their lack of understanding and education versus reality and facts. And we have found that this is especially true when it comes to understanding the long-term tax benefits and the internal rate of return that is actually being achieved. Now, your financial professional has more than enough on their plate already, and they have many things that they're responsible for in growing your money. At Clear Diamond Life, this is the only thing that we focus on. And again, we want to focus on that portion of your portfolio that you cannot risk to lose. We have assembled the top team in the nation at designing and implementing the strategy, and behind the scenes in our San Diego office are about 30 of the brightest minds in the insurance industry. Their sole focus is understanding, studying, designing, and refining your Index Universal Life Insurance plan. And yes, we may do a few annuities here and there or a structured cash flow from time to time for people that can't qualify for an Index Universal Life Insurance, but all in all, the majority of what we do is this strategy and nothing else. In fact, in 2016, our office in San Diego protected 4,347 lives with this strategy, resulting in over $270 million in assets protected, either through an Index Universal Life Insurance strategy or an annuity. So again, the strategy has been around for decades. So there's an old adage that says, what you don't know, you don't know. Well, now you know that there's a better place for your money. And one of my favorite phrases is good, better, best, never let it rest until good gets better and better gets best. So when we talk about our 401ks, that's a good strategy. When we talk about our tax-exempt accounts, that's a better strategy. Now when we're talking about a tax-free opportunity or strategy, in our opinion at Clear Diamond Life, that is the best place to put your money.
Our next question comes from Matthew. Can you please explain what the average rate of return is?
Matthew, that's really a great question, and this is one that I really want you to pay close attention to, because many advisors tout that their clients earned an average rate of return of, let's say, 8% during the last 10 years of all this economic turbulence we've been through. While that may sound great, it doesn't necessarily mean that you would be ahead. So here's an easy example. Let's say that you had initially $100,000 under management in an account, and in year number one, you suffered a 30% loss, resulting in an ending balance of $70,000. Now let's say year number two, you had a 50% gain, resulting in an ending balance of $105,000. That's an average rate of return of 10%. Likewise, if you had that same $100,000 in an index strategy, and let's say that in year number one you had a 10% gain, resulting in an ending balance of $110,000, and in year number two you had another 10% gain, the ending balance would be $121,000. But guess what? That too is an average rate of return of 10%. But in investment number two, you had $16,000 more than you did in investment number one. So which one would you choose? That's what an Index Universal Life Insurance strategy will guarantee you, is it takes away that market volatility. So when we look at average rates of return, we know that we're looking at true numbers because it allows you to participate in the gains without the risk of any of those losses whatsoever. Again, this may be really hard to comprehend, but if it's something you want to circle back to, we can definitely do that during our meeting. So again, fill out your survey, complete that questionnaire, get it back to us, schedule an appointment, and we'll be happy to sit down and explain exactly how that works for you.
Next up from Dana. So, is this considered an investment?
Dana, no, life insurance contracts are never to be considered an investment, nor should they ever be classified as such. They are, however, a very powerful financial strategy that should be part of your overall balanced portfolio because they will yield you stable wealth accumulation through tax-deferred growth, tax-free retirement income. You're able to access your money at any time. And when structured properly, your money will last into perpetuity. But again, we never want to consider them to be an actual investment because they're not classified as an investment. This strategy is classified as life insurance. So we just want to be very, very clear on that.
Our next question is from Javier. Is there a better time of year to start my policy?
Javier, no, there's actually not a preferred time of the year to start a policy because if you remember when we covered the lock and reset feature of the strategy, the lock and reset is an annual reset. Therefore, it really doesn't matter if you start today or in 6 months, as whatever date your policy goes into effect, that will be your annual, what we call sweep date. That is the date the gains are swept into the account and we reset for the next year's market activity. So we've actually taken some time and we've analyzed data over the last 20 years to really see if there were any trends that seemed to be better dates than others, but there really wasn't anything that was noteworthy to mention for best start dates. So we always say it's best to start today because we do want that compound interest working for us as fast as possible.
Another question from Adam. I have some money right now, but I know I have a lot more coming to me within the next 2 years. What is the best advice?
Well, Adam, if you remember from earlier, I always say that you don't want to put the cart before the horse. And remember also that to fully fund or to maximum fund a policy using the strategy that we recommend, it does take us about 4.5 to 5 years. So if you know for absolute certain and beyond any shadow of a doubt that you do have the funds necessary to fully fund the policy within that time frame, I would say that it's probably best to start the policy as soon as possible because our buckets can always be backfilled if your funds are delayed. Now, we would only want to do that so we don't have lost opportunity as far as time is concerned. However, if there's any doubt whatsoever that the funds may not be received, I would caution you to only start a policy that is sized accordingly with the known money that is currently available, because we never want to shoot for the moon but only hit a tree. So again, it's really imperative to make sure that you're working with the money that you know that you have, or you're absolutely positive that you will have it no matter what can possibly happen. Usually those funds are involved in a trust or some type of situation where you know that you have a date coming in the future where those funds will be available.
Our next question is from Himar. Why shouldn't I just get a Roth?
Well, Himar, there's absolutely no reason not to consider a Roth, as they do have similar tax benefits as this strategy does. However, they do come with a downside, and typically your money is at risk in the market. So having principal at risk is a mistake that millions of Americans make with their retirement nest eggs, and we've seen that over the last couple of decades. So with the strategy that we teach at Clear Diamond Life, we eliminate the risk of market volatility and we participate only in those market gains. Also, government-sponsored Roths have got small contribution limits compared to almost limitless maximum funded tax-advantaged life insurance contracts where the contribution is virtually without limits depending on your maximum maturability that we talked about earlier. Now, the other downside to a Roth is that you don't have the death benefit associated with your money that will transfer to your heirs tax-free and affect future generations. But we always want people to look at the Roth, and as long as the fees are not outrageous, it's not a bad plan for somebody that's not able to maximum fund an index universal life insurance contract.
Our next question is again more of a statement from Rita. My financial planner says that my tax bracket will be lower at retirement.
Well, Rita, that may be true for the bottom 75% of wage earners, but oftentimes we see a complete opposite situation in the top 25% of wage earners. And many people do believe that their tax rates will be lower in retirement. And they may in fact be correct. But what if they're not? Most people want to maintain that same lifestyle that they currently enjoy, and in fact sometimes they increase it since they're now free to travel and enjoy life. And also now most people no longer have the tax deductions that they had during their working years that we covered in our earlier segment, such as the mortgage interest, child credits, and government-sponsored retirement plans. So we actually have many clients that end up in a higher tax bracket because of this, as well as minimum mandatory distributions. Now, conversely, if your income is lower, you could still have a significant tax obligation due to the loss of those deductions. But again, we're more than happy to provide you with your customized wealth report based on your unique situation. So once you've completed and returned your forms, we'll schedule that call, we'll determine what your situation looks like and what the best strategies will be for you going forward.
Our next question comes from Aaron. How does leverage work? You mentioned this earlier.
Aaron, I'm glad you circled back to that because leverage is really one of the benefits that we sometimes don't have a lot of time to go in depth into. But as I mentioned earlier, when you complete your confidential client profile, you're going to receive an email with a link to create an account where you can watch our library of 14 educational videos that recap and go into more depth on these strategies that we've discussed over the last hour and a half or so. However, in video number 4 titled The Wealth Builder, I have my team go into great detail regarding this powerful benefit this strategy has to offer. This concept doesn't exist in any other financial vehicle, and again, it must be structured properly in order to take advantage of it, but here's the premise. So if you'll remember, earlier we talked about maximum funding our policy, or essentially getting as much cash into the policy as fast as we can to still maintain its tax advantages, and again, typically that takes 4 to 5 years for most people. Now, once that cash is in the policy, imagine being able to withdraw the majority of it to use for any purpose you can imagine, such as buying a car, the down payment for a house, funding a college education, or basically just about anything you want to use it for, as long as it's a wise use for that money. Now, here's the best part. The original basis will continue to accrue interest. So you heard that correctly. The total amount that you originally put into your policy will enjoy uninterrupted compounding of interest at that same original amount. Now there is a slight catch, but it's one that should be expected. You cannot realize these gains until the amount that you have borrowed is paid back at some point in the future. Now, there's no set payback schedule, so you can pay yourself back as it makes sense for your particular situation. So again, this is a complex strategy, and it's one that we can go over in our discovery session once we schedule our appointment with you.
Next, we have a question from Dahija. If this is something that my wife and I want to do, and it looks like we do, will we be working with you or with one of your assistants?
Dahija, hey, that's another great question. While one of my wealth architects will assimilate your 22-page wealth report from the information that you complete in your wealth assessment, you will always be working directly with me while we discuss your unique strategy and implement a plan for you. So really, the only time you would possibly work with one of our wealth architects is if I'm outside the office or tied up with a client. However, rest assured that any member of my team is fully capable of answering basic questions on my behalf, but we have built Clear Diamond Life by being fully accessible at all times. So yes, you would be working directly with me most of the time. And Jeff, I know you have a lot of questions that remain, but let's just take a couple more because I know we're getting close to the top of the hour, and I really want to cut this off at exactly 1 hour for the Q&A.
The next question is from Pat. When I eventually die, what happens to trigger the next event?
Wow, there's a question that doesn't come up too often, Pat, but it's another great one. At Clear Diamond Life, we take a very unique approach to every aspect of wealth planning, and we're the only company that I'm aware of that has created what we call your EAS, which stands for Emergency Alert System. The system is just that in case of an emergency. In this case, you're passing. Someone on your EAS would call us to advise us of your passing. We in turn would then notify the carrier immediately, and they would get in touch with your beneficiaries to process the final transfer phase of your policy. The EAS is generated during the application phase, and it works like this. We ask you to list 5 people besides a spouse that would know of your passing immediately. We then call them to introduce ourselves as your representative of your life insurance policy. We then ask them to take down our information and to notify us immediately in the event of your passing. And in addition, we send them a letter explaining that same information that we have just discussed with them, as well as our contact information and the contact information of the insurance carrier. This is a very important step, and it's one that most other companies completely overlook. In fact, if you've ever seen the unclaimed money fund from your state, a lot of that money that sits in those funds, it's because insurance companies cannot find the beneficiaries when it's time to invoke that phase of your policy. So we take that very serious, and it is one step that we do not overlook.
We have another question from Javon. Why should I trust you with my money?
Well, Siobhan, the good news is that you don't have to. You should never send money to anyone at Clear Diamond Life. Should you decide to implement one of the strategies we designed for you, any monetary exchange occurs exclusively between you and the insurance company. So even though we are your licensed representative, you will never see an invoice from Clear Diamond Life, nor will you ever send a dollar to us. Again, every dollar that you put into one of our plans has the full backing and guarantees of the insurance companies.
Next, we have another statement question coming from Juan. He said, life insurance is too expensive.
Well, one, it certainly can be expensive because traditional insurance planning has you purchasing the most amount of insurance that you can qualify for. So that myth, again, that most life insurance is expensive and it's associated with high fees can be true. Now, you may also be looking at insurance as a purchase rather than a vehicle where your money can grow tax deferred. You can access the gains tax-free and your accounts transfer tax-free. And as we stated, a properly structured indexed universal life insurance policy will be less expensive over the long run, even when compared to traditional investments, as we are purchasing that minimum amount of death benefit, again, that the IRS will allow us to purchase. So again, we are not in this strategy for the insurance, but it is the required mechanism to be able to take advantage of the benefits we have discovered.
And the next question is the last one that we're going to have time for today. It comes from Casey. Why doesn't my financial planner do this if it is so good?
Well, Casey, that's a great question to end this segment on, and I think we already covered that, but just to add another thought, these strategies typically don't happen overnight. Even though we do have express underwriting available for the healthiest of individuals, many of these plans may take 3, 4, sometimes even up to 6 months to get through the underwriting process. So therefore, it's not the quick sale that most money managers focus on in their day-to-day activity. And as we covered earlier, our 7-step process is unique to the industry, as we may need to meet with you 6, 7, or as many times as necessary for you to fully understand all the moving pieces of this strategy. So by the time your policy is ready to be funded, you will know more about taxes, tax-deferred wealth accumulation, and tax-free income than most financial advisors in the whole country understand. At Clear Diamond Life, this is the only thing that we focus on, and this is what we're experts at. I want to thank everybody for the time you've spent with us over the last 2 hours. I hope it's been informative, and I sincerely hope you take the time to fill out your forms and to request an appointment to meet with us, because I know for a fact that we can seriously make a significant impact in your lives today, tomorrow, for the future, and for generations to come. Thank you again, and I look forward to talking to you very soon.